Hey everyone, it's Rob B with Rob D, and you are listening to the Property Podcast. And we today are annoying a lot of people.
Yes, welcome, perhaps for the last time, to the Property Podcast. We run a business that buys more than £100 million worth of property a year for our clients. You can find out about that at propertyhub.net/invest. And when we are thinking about where to invest, we are, of course, implicitly thinking about where not to invest. And it's those latter areas that we are talking about today. Yep, we are going to list the worst places to invest in 2025. So if you want to avoid making a mistake in the biggest decision you will ever make when it comes to your investment, which is where to buy, make sure you stick around.
It's time for our news story of the week, and this week our news story comes from Hamptons, and the headline reads, "How buy-to-let returns stack up after a decade of ownership." Well, Mr. D, how do they stack up?
Well, surprisingly well is the answer, because they are looking at ownership over the last 10 years. As we've spoken about on this show multiple times, the last 10 years, historically speaking, has been spectacularly bad for property. So I thought that these numbers would look pretty grim, especially because they have not taken account of leverage. They've run their figures assuming you're buying purely in cash. So what they've basically done is taken the cash purchase price, worked out the capital gain, worked out the rental income, and taken off 30% for costs. So you can argue about the accuracy of these things all day, but after doing that, the average annual total return, when you add together the capital growth and the rental income, is 8.6%. And I think 8.6% is really good, considering what a poor decade this has been, and again, that this is an unleveraged purchase. It's got a regional breakdown as well, and as will not surprise you, I'm sure, if you're a regular listener, the average annual return was lowest in London at 6.5%, highest in the Northwest, which is where we do most of our deals, at 12%. And the really interesting bit for me, Rob, is the proportion that came from rental income versus capital growth. And the answer, pretty much even split. 51% from rental income, 49% from capital growth. But again, remember, this is an unleveraged purchase. So Rob, I haven't done the figures, but what I know for sure is that if you added leverage into the equation, then the proportion that came from capital growth compared to rental income would be way higher, way above half of your return would in that case be from capital growth. And this, remember, over a decade when capital growth has been really low.
Yeah, I'm actually a bit surprised that capital growth is 50% when you haven't used leverage, because, like we keep saying, it's been a bad 10 years for property. But what also is clear to see here is how important it is to pick a good area or avoid a bad area, because the difference between London at 6% and the North East at 12%, that's each year on average. So when you compound that, it's huge. And then you add leverage, as we've said, it's even bigger again. So picking the right areas is so important. And we often talk about the best areas to invest on this podcast. And we have highlighted previously that London isn't an area that we would have invested in the last 10 years, and the data shows rightly so. So today we want to help you avoid making those mistakes. And we're going to list areas that we would absolutely not invest in 2025. And the great thing about this episode is that we pee a load of people off. We're going to get people riled up because there might be an area that you love. It might be an area that you live. And we might pick it out as an area not to invest in. And we'll explain why at the end. But it's important to say that our focus is on capital growth. And if you're investing for yields, and if you're investing for holiday lets or anything like that, we'll explain at the end why you should still avoid these areas. But our focus is capital growth, because we just demonstrated in that news story the impact it can make if you get it wrong. So, Rob, I don't want to start off by annoying people, so you can start. What is the first place on our list? You could be the bad guy.
Well, we need to get our hosting bill down and shed some listeners, so let's start strong.
And I really like this place to visit, I must add, so I can't say it, because I like going here.
Okay, fine. You preserve yourself, and I'll say it. Number one is most of Wales. So if you're investing in Wrexham, Cardiff, Newport or Swansea, you get a pass. You're okay. Rest of Wales, no. We are casually writing the whole country off.
We're starting small here. We're just taking out a country.
Yeah, and okay, this is pretty broad brush. And at first, that seems weird because we're talking about capital growth. And if you go and look at the regional capital growth tables from the last few years, Wales has been close to the top, and it kind of makes sense because affordability is pretty strong. There's headroom for prices to grow, as there is in places like the northwest and the northeast of England, which are places that we are keen on investing in. So why are we therefore saying that most of Wales is not the place to invest if you're looking for growth? Well, it's because that growth that Wales has had has been driven by the areas that we've carved out. It's been driven by the big cities like Cardiff and Swansea, and it's been driven by holiday lets, which we'll come to later. And the reason for that, Rob, is that is where the fundamentals are. And it's the rest of Wales where the fundamentals are, largely speaking, missing.
Massively so. Like, the transport links for a lot of Wales is really poor. And it's not the only place on our list that has poor transport links, but Wales really does have poor transport links. Also, employment out of those cities that we've mentioned, or those big areas that we've mentioned, is also a bit restricted as well. Now, that does not mean that Wales is not a lovely place. It absolutely is. So please allow me to continue to carry on over the border. But Rob, I'll take us into Area 2. And I do visit this place occasionally, but not as much as Wales. So I'll take the hit because we're just going to take out another country. Second on our list, Scotland. Hi to everyone up there. We know we have a lot of listeners in Scotland, so enjoy your last episode. So Scotland, let's face it, hopefully even if you live and invest there, you know that there's a war on landlords. And that war is by the government, the people setting the rules around buy-to-let and renting. And I think war is a strong word to use, but it certainly feels like that for those who've operated in that market. You got much stricter eviction rules there now than ever before, the strictest in the UK. And rent controls during COVID made it very difficult to operate. Now, those rent controls have just ended, but there is a new bill planned to make it permanent. So it was a temporary thing, but now they just want to carry that on. And that has been a nightmare for the rental market, for both landlords and tenants, I might add. It's not been an upside for one group. It's been a lose-lose situation, but it sounds good. And that's why it keeps getting pushed. And that's why Scotland is absolutely in our list. You know, Scotland has amazing fundamentals in places like Edinburgh and Glasgow. But because of this, it makes it, for us, absolutely uninvestable. And actually, if you look at the major institutional investors, the pension companies, the people who put millions upon millions, even billions of pounds into the residential sector, 9 out of 14 have said Scotland is a no-go. So 14 out of 14 will operate in England, but 9 out of 14 won't touch Scotland. So it's not just us two who are anti-Scotland as far as investment's concerned. Wonderful people, wonderful cities, a terrible place, in our opinion, to invest in 2025.
Yeah, we need to caveat all of this by saying that, of course, there are people who are making investment work and will continue to make investment work in every location that we're talking about. But we're coming at this from the perspective of, if you could choose anywhere, there are no practicalities, there's no baggage, there's no emotional attachment, why would you make life harder for yourself? And investing in an area where the government so clearly doesn't really want you to be there is certainly making life harder for yourself.
It's like riding a bike, Rob, with flat tyres. Yeah, you can do it, but why would you choose to? That's how it is.
Strange metaphor, but I'll go with it. Yeah. Let's move on to our next area. And I feel like we've got to do an area in England now or we'll be in real trouble. So let's casually wipe out the area that both of us live in, the whole of the southeast of England. And what we've got in mind particularly here is commuter areas within an hour of London, which is a lot of places. So again, we're going broad brush here. But note that we're not talking about London itself. London is a bit different. Like it or not, London has got the prestige factor. It's got the international demand. It's got the incredibly strong financial sector. It's got resilience. London's going to have times when it's better to invest or it's worse to invest, but London is always going to be London. The problem with commuter areas into London is that they've got all the drawbacks that the southeast have right now, which we'll get to, but they lack that prestige. So all of the negatives, none of the positives. And the negative is broadly the fact that prices are so high, but that has several knock-on effects. So outside London, the highest property prices in the country are, understandably, in the southeast of England. That is particularly a problem. Now mortgage rates have gone up, and it's particularly a problem for investors. Now, the stamp duty surcharge for investors is now 5%. An extra 5% on an investment property, which is probably going to cost you, $500,000 for somewhere reasonable? That is a lot of money. And because prices are so high and have grown so quickly, there's a lack of growth potential. There is a pattern that we're seeing, which is so absolutely crystal clear, which is that the prices in the southeast have hit the ceiling. They can't get any higher until wages grow. Whereas in the rest of the country, affordability is better. It's the time of those areas to catch up. It used to be the case that you'd buy in the south for capital growth and the north for yield. That's not the case now, Rob. That trade-off doesn't exist anymore. You get the best of both outside the southeast. So why would you invest there if you had other choices?
I have no idea, Rob. But interestingly, if you own a buy-to-let there already, I wouldn't be panicking listening to this, because I think because it's so unattractive for buy-to-let, for all the reasons Rob's laid out, that less people will come into the market. And as rental stock comes off the market, which it does naturally when landlords sell up, for example, that the rental market could become reasonably strong. So it's a no for now, but with some of these areas, it's a no pretty much forever, unless something very dramatically changes. But with the southeast, it's a no for now. But because of the reasons that make it so unattractive right now, it may become attractive again at some point in the future. Next on our list, we're taking on a sector which has areas we can list, and we will, but it's more of a sector, and it's holiday let hotspots. We'll explain at the end of the show how you could possibly make this work. But we are looking at areas like the Cotswolds, Brighton, and again, parts of Wales, large parts of Wales. So those areas are very attractive for lots of reasons. Lots of people want to go and visit those areas. So why are we picking on them? Well, first of all, holiday lets have lost their tax advantages. Now they get taxed like regular buy-to-lets. And one of the reasons lots of people piled in was because of those tax advantages. So now they've been removed, it's not so attractive. Also, you could be paying more for council tax, because if it's not rented enough days per year, the council can charge up to 300% off the normal rates. And because so many people did flood into the market with COVID and after COVID, because there was a huge surge to UK holidays, there's oversupply. And there's lots of examples where people are now converting those holiday lets back into normal buy-to-lets. But would they have chosen those areas as a buy-to-let area initially? Maybe not. And if you've invested in somewhere like Brighton, converting it back to a buy-to-let, great. You could probably make that work. But if you've invested in a remote part of Wales, turning that into a buy-to-let might be doable, but it wouldn't be in your first 100 areas to invest in as a buy-to-let. So it depends where you are, whether you can make that work or not. But for all the tax changes to the sector, the oversupply in the market, and now that people's holiday patterns have returned to normal, which is a lot of people in the UK getting away from our iffy weather and going abroad, means that hotspots are absolutely on our list.
Yes, they are. And let's move on to our last one. And it has to be our last one because we want to retain some listeners. And I think we pretty much slammed the whole of the country one way or another. So where have we missed? Well, the last area, or rather collection of areas that we'd avoid, are very cheap areas. And again, at first, this might sound strange because we just said, well, the problem with the southeast is that prices are so high. And in places like Yorkshire and the northwest, prices are lower, affordability is better. Therefore, that all-important capital growth potential is there. So why are we now saying very cheap areas should be avoided? Well, it's because there is such a thing as too cheap. There are areas that are relatively better value, and you could say that they are underpriced because they've got the fundamentals, they're economically strong, they're doing well, they're getting better. It's just that hasn't been recognised in prices yet because the southeast has been dominating up until the last couple of years. And then there are areas that, let's just say, don't have those advantages. And again, it mostly comes back to fundamentals. So some places on this list would be Carlisle, Blackpool, Middlesbrough, Barrow. What do they all have in common? Again, mostly weak fundamentals. Generally, the transport links aren't great and the job markets aren't great. There's either weak employment or there's just one big local employer, which makes it vulnerable to change. And the knock-on effects there are massive, because if you do have low or unstable employment, then it means you've got higher tenant risk. And it also means because there's no force pushing prices up, you don't get that capital appreciation, which is what we're looking for. And I think, Rob, this is such an important distinction. I don't know if you've got any advice to help people make this distinction, because it can be a subtle one, yet it's such a critical one. It's like, how do you know if an area is cheap because it's an opportunity versus an area is cheap because it's just going to stay cheap? Coming in cold as a new investor, that's not something that's necessarily easy to work out, yet it's critical because it can absolutely make or break your entire investment.
Fortunately, I think it's easy enough to do. It just requires a little bit of thought, a little bit of research, but most of it is common sense. And you've rightly pointed out, Rob, that those areas have poor fundamentals for one reason or another, or in some cases, multiple reasons why they've got poor fundamentals. But there are cheap or cheap-ish places that have very strong fundamentals. Now, this place isn't cheap now, but it used to be. And we picked this as an area in 2015, which was Manchester. Manchester in 2015, when you looked at house prices, was cheap, but the fundamentals were phenomenal. So for us, it was a no-brainer. It was clear that this mismatch of price versus fundamentals had to change. And it did, in a big way. And then it became Greater Manchester, because Manchester had started to push on, and Greater Manchester offered great value. There were places that were very cheap, like Stockport, but had incredible fundamentals themselves. And once again, that changed. And Stockport now has seen great capital growth. And those areas will continue to have great capital growth because of those fundamentals. But I'm pleased to say there's other areas. More recently, if you want to pick cities out, you could look at, say, Liverpool or Sheffield and go, as cities, they're quite cheap when you compare them to other cities, but the fundamentals are very strong. Another city that we've talked passionately about, because we just feel there's this huge opportunity there right now, is Derby. Derby, compared to a lot of cities in the UK, is cheap. But again, the fundamentals, brilliant. Towns like Doncaster, incredible fundamentals, but in the top 20 cheapest areas in the UK to live. But we love Doncaster as a buy-to-let area. So it's not cheap is bad. It can be an incredible opportunity. And it's just pivoting from these areas to some of the areas we've mentioned. Can see you do very, very well. Yes, picking on countries can sound bad, but I think people living there can understand why we've named them. But I actually think as investors, this list, the Blackpools and so on, will be the ones where we have most people investing in who feel a bit aggrieved. And that's probably because they're after yield. But as we've said, this list is all about capital growth. And this leads us nicely into our overarching point, is that even if you want yield, or even if you want to do holiday lets, there are places that you could choose that will protect you from a capital growth point and still allow you to attempt that strategy. So for yield, already mentioned some of those areas, but Derby yields are strong, Doncaster yields are strong, fundamentals are brilliant. So you can still go for a yield play, but have the chance of great capital growth. If you are insisting on doing a holiday let, you could do Chester, you could do York, or maybe even Liverpool as a holiday let option. If your strategy doesn't work, then hopefully you've benefited from some capital growth because those areas all have great fundamentals. And you know it will work as a buy-to-let strategy as well. So it's not to say don't do these other strategies. Don't go after yield if that's your goal. Or don't do holiday lets if that's your passion. It's saying play it safe. Pick an area that's got a good chance of capital growth. So if you are wrong about your strategy, you're still protected by that capital growth. And that is where the real money is made, especially when you leverage in property. It's the capital growth. Even if you are after yield and you are very focused on a short-term income, it's great to have that income, but after you've owned it for 10 years, you'll look back and go, I made more money through capital growth. We've demonstrated that with a news story this morning. When you leverage, you will make more money with capital growth. And that is why we would not invest in any of those areas. Bad people in those areas? Absolutely not. Bad places to invest? Yes.
Okay, so having alienated a large part of our listener base, let's see if we can win a few people back by making a peace offering in the form of Hub Extra. This is an app that producer Dan actually found and put our way, which is called Sprive, SPRIVE.com. And what it basically is a cashback app. There are loads of these that give you something back when you shop through them. But what's interesting about this one is it hooks into your mortgage account and it allows you to take that cashback and overpay your mortgage with it directly within the app. And of course, there's nothing to stop you getting cash back in another app and then separately calling your lender and making an overpayment. But I think the framing of this is really clever because removing friction is what it's all about. But who actually does it? Basically no one. So I think the fact that you can do it in the app is really clever. And the way that they present it to you gets you really thinking about the value of doing that. Because of course, £50 off your mortgage doesn't sound like much, but if you work out the interest that you would have paid on that over the next 30 years, it ends up being quite a lot. So you're not going to be able to use this on most of your buy-to-let mortgages because it only works with certain lenders. For your home mortgage, it might be worth a look. But I think most of all, just a round of applause for Sprive because it's a really clever idea and really good positioning that gets you thinking about the impact that those small changes can make over a long period of time.
A round of applause to you, dear listener, for making it this far and not getting so angry that you've had to turn off the podcast. If we've kept you for this long, then you show you are well balanced as a property investor.
Or you're driving and can't get to the controls.
Yeah. And if you are, I'm really sorry, but don't take out on other drivers. Stop honking your horn and driving aggressively. Now, hopefully you will join us again on Sunday in the Sunday Times, where we will be answering your questions, and on Tuesday with Ask Rob and Rob. And of course, we'll be back, same time, same place next week, bringing you another property podcast. Until then, take care, have fun. Bye-bye.
Bye-bye.